All right. Awesome. Well, I'm excited to get started here in a second. We got some great people here live with us, so I'm sure we'll have a good conversation.
Well, we got the pride of Alabama here.
Very true. I'm gonna go live on Instagram. I think that is I've never done that before. All right. Awesome. Well, I'm excited to get started here in a second. We got some great people
We don't
here
want
with us.
a reverb on that.
Yeah, that's awful.
So you're going live too.
Yeah, sorry everyone. We're having major technical difficulties. We're embarking on first ever mission here.
It's like basically the first steps on the moon, the first ever live LSCRE webinar or
This is
podcast.
like this is
Tomato,
like
tomato.
Gen Z version of Boomer Tech. I can't figure out how to go live on Instagram, actually.
This is really good and really captivating content.
Yeah, well, why don't you recap the podcast that we did this morning?
Well, for those who are weekly listeners, perhaps of the LSCRE podcast, myself and Rob had an incredible episode where we really dove into the latest and greatest of my X addiction, particularly pertaining to the financial news. So, if you have heard of
Yeah, I
places
figured it
like,
out.
call it Unusual Whales or other kind of economic headlines and stuff like that, we kind of broke them down, including where the S&P 500's at and kind of the PE ratio there, whether it be the kind of commercial debt, particularly pertaining to the office delinquencies and housing market. We really dove in there. So that episode will be coming out on 11/17. So I look forward to have that being published. It was very lively and colorful. So
All right, let's go. We got people joining live on LinkedIn. Or not LinkedIn, Instagram. All right, pretty cool. Well, let's go ahead and get started. We got things firing on all cylinders here. We're live on YouTube. We're live on Instagram. So, for the few people on Instagram, if you do want to join us actually in the Zoom, you can go to lscre.live and join us there. We're gonna have a full, I think we'll hopefully not a full hour, but we'll run the gamut. We'll have Q&A, so we're gonna make it interactive. First of our monthly podcast here live. So without further ado, I'm gonna go ahead and share my screen. And what I'm going to be talking about today is a
markets.
multifamily market shootout. So this is gonna be bad radio for you guys on Instagram, but here I'm sharing the IPA 2025 multifamily forecast. And so this is pretty stale information now because we're almost in 2026. And so I'm super excited because IPA is going to be coming out with their 2026 multifamily forecast coming, around NMHC in January. So I wouldn't say that IPA is necessarily the best or certainly not the worst, but you can get this sort of information from any of the major brokerages, whether that be IPA, Newmark, Berkadia. So this is just the one that I had on hand, and I found this one to be quite interesting, and we're going to use it as it's not an exhaustive way to analyze a market by any means, but it's just a very high level. So what I mean by that is we'll just pick the very first market that it has to offer us. So Atlanta, right? It's A through Z. So Atlanta,
Hotlanta.
we Hotlanta. As you can see, if you are joining us on Zoom, go to lscre.live to join us live on Zoom.
You mean on Instagram? Yeah.
No, no, no. We're here on, I mean, I'm talking to my people on Instagram, but
Okay.
okay. So basically on in Atlanta, you have employment. Someone said no audio on Instagram. I really hope that that's not the case, but so be it. So here in Atlanta, for example, employment growth 1.4%, right? 42,000 new jobs. Okay, that's more than the national average of 1.1%. Okay, you might say that's good. It's better than the average, but there's two parts of growth. You have supply and demand. And so you have to have a good balance of both. So you have employment, but then you also have construction. And so we've gone through a period in multifamily of record construction. So we've actually built more apartments in the last few years than we did in almost any year in history. So here in Atlanta, it's not so bad, but here you can see 2025 forecast was 2.9% of inventory under construction. So what that means is, let's say Atlanta has, I'm just making round numbers up here, 100,000 apartments. You would then say, well, there's actually 2,900 apartments under construction, and they'll be added to the inventory to the market. And so that's going to disrupt the equilibrium because then when you add all these new apartments, it's going to actually imbalance the supply and demand, and you're going to have more apartments than you have demand for apartments, and that's going to cause rents to go down basically, either by way of concessions, occupancy, or actual rents to go down. So this
Two
is such.
point, yeah, 2.1% is not, or 2.9% is not heinous in relation to a lot of the other big MSAs, which obviously Atlanta would be part of that, right? So, 2.9% is not nearly as bad as what, other markets that we're going to get into. But I kind of have a thought here at first, which is, the moratorium, right? Or weren't there a lot of tenants who effectively during COVID didn't have to pay their rents essentially due to the problems there, which, from a market perspective, kind of gets me concerned if I were to be an investor.
Sure. I mean, that's definitely a concern and perhaps a future concern as well because they did that before in Atlanta. But yeah, you're right. Like although Atlanta is known as such a strong growth market, right? It's in the South, it's in the Sun Belt. It's one of those hot markets that people like to invest in. And consequently, a lot of these very hot markets throughout the Sun Belt were the most overbuilt because where there was excitement and appetite for investment, there was also excitement and appetite and capital for development. And so we saw Phoenix, Charlotte, Austin, San Antonio, a lot of these markets in Denver that got really overbuilt and are still experiencing the hangover of that supply. So the thing about supply is it's very easy to track because you have permits and then shovel in the ground and then you finish and then you lease up. So it takes years and years actually to go from, start to finish on a construction project. So you can forecast out years ahead. So when people had all this money, right, there was just so much liquidity, they were starting to do all these development starts in 2020, 21, 22, and now they're getting completed and leased up in 24, 25, 26, and that's why it's been years since it was easy to develop when rates were low, lots of capital available, cap rates were lower, but we are now just now really experiencing the full brunt of the construction overhang, and hopefully depending on the market it's going to kind of die down and be on the up in 2026. And then the markets that were the most inundated with supply, it'll be more like 2027 when they'll probably fully bounce back. So the point of this conversation is not just about Atlanta. Obviously, we're going to be covering many markets and using this as like a high level guide to discuss because people get caught up too much on the one side of the equation. They say, wow, look at this market. The population is booming. But then they are totally missing the fact that supply is booming as well. And so you're
Sorry,
really
what did
not
you say
getting the
about
growth.
Austin, Texas? I couldn't hear you.
Yes, Austin, San
Or
Antonio,
Phoenix?
Phoenix. It's very sad, but good markets nonetheless. Just unfortunately, supply is a real thing. So somebody on Instagram said, shout out from San Diego. San Diego, incredible market, very difficult to build. And that's why you don't actually need to see a ton of population growth or job growth to see positive rent growth because it's so hard to develop. So before we move on, I'm just going to let everybody know on Instagram that I'm going to wrap up the live. If you want to join us, go to lscre.live and you will be able to join us here on Zoom. So we'll see you there. Okay, so now moving on. Do you have anything to add before we move on?
No, Atlanta, I mean, let's just forecast it, right? Let's be in a world where 20 years of our future self is going on, and we're regionally in several locations, right? Above and beyond Texas, hence why we are rebranding for a multitude of reasons to LSCRE, not Lone Star Capital. Is Atlanta a place you'd maybe want to participate in? Our dear friend Patrick Carroll made a small fortune in that Atlanta market. Could we do it as well? What's your take there?
No,
Do you
I'm
have
a pass. I'm
aspirations?
I'm a pass on it.
All right, he's a pass.
I'm a pass.
Tribe has spoken.
So, okay, so we talked about supply demand being a two-sided equation, obviously, supply and demand. And here we are representing those two things. We're oversimplifying things, but we're representing them through employment and construction as a percentage of inventory. And so, and also employment is as a percentage as well, because you need to normalize for population. If Houston, being a massive city that it is, if it's only adding 40,000 jobs in a year, that's not as impressive as Atlanta. I mean, both are massive, but Houston is bigger, right? And so if you look at Salt Lake City, even smaller. So really the percentages are what matter. Same thing with construction. So, but then there's a third part of the equation because supply and demand, yes, that will speak to growth, but also it's very important to understand how much you're paying for that growth or lack thereof. So whatever the level of the growth is, and that is reflected in a cap rate. To put it really simply, right? People like to make things very complicated with yield on cost and IRR and all this sort of stuff, but the cap rate is your yield essentially, and it's quite simple. And so logically, if you see a market where there's very healthy supply demand fundamentals, meaning there's, let's say, employment growth of 2% and construction as a percentage of inventory of only 2% or 1.5%, you would say, wow, that's a great market. It's probably got positive rent growth. If not, it's right around the corner. It's going to do very well. But then you have to look at what's the cap rate that I have to pay for the privilege of owning in a market with tailwinds like that. And so that's the third part of the equation, because if we jump over to one of our target markets and one of the favorite markets in the country and arguably the most liquid apartment market in the country, Dallas. Okay. Dallas is on everyone's lips. Everyone wants to own in Dallas. Everyone wants to invest in Dallas, from the retail investor to the institutional investor. It's highly competitive. It's highly liquid. And for that reason, the yields are tight. And when I say yield, I mean that as cap rate as well. So whether you like it or not, and whether it's justified or not, the cap rate in Dallas is very low. And the reason for that is because capital wants to be there. And so they're going to bid prices higher, and the higher you bid the price, the lower the cap rate. And if we look at the fundamentals, again, this is oversimplifying things, but if you look at these fundamentals, the job growth is an impressive 1.9%. It's nearly double the national average. But construction is 3.7%, also nearly double the national average. And it's a little bit imbalanced, right? You've got more construction than employment. Not that these percentages perfectly align with each other, but it's a little on the high side. But the thing about Dallas is it's so resilient, so robust that it continues to absorb any amount of construction that you throw at it. So people continue to want to invest. But the question is, these fundamentals, is it worth paying the prevailing cap rate in Dallas? Four
Yeah,
cap, five cap?
and one thing we actually haven't really gone to and kind of double clicked on, you've kind of brushed over it, but really the ratio we kind of are really liking and thinking about here for those who are here visually looking at this page is the employment and the construction ratio, right? So you can see here about 1.9% new jobs being added. That's obviously are close to almost double the national average of 1.1%, 82,000 jobs to that market there. Construction inventory, 3.7%. So, when you look at that ratio, Rob, can you kind of explain in the Rob Beardsley way why we're kind of honing in on that there?
Yeah, I mean, to me, it's the most kind of truest ways to evaluate supply and demand, because population growth is great, but people, they are nothing without the jobs, right? Because jobs are what really, a job equals a person, right? A person has to work the job, but then that person has to live in order to have that job in an area nearby. And what that means is they have to most likely rent an apartment or a home in that area, and that boosts demand for multifamily in that area. Even if they're buying single family, whatever, right? Employment drives everything. If you have white collar jobs that are growing and the person is making six figures, right? That's going to bring along with it service jobs and everything ancillary around it too. So it's a big boost to the economy, big boost to multifamily. So that's why we're looking at employment rather than looking at population growth, although it's totally valid. And then I already explained about construction, right? The more inventory you add, the more pressure you're going to put on pricing. It's just simple supply and demand. And this is kind of why rent control doesn't work. If you try to stop the increase in rents, then people are not going to be incentivized to build new product. If there's not new product, there's going to be a shortage of product. If there's a shortage of something, the price is going to go up.
Yeah, this goes to kind of the, Econ 101 to a certain extent, but actually was having a conversation with someone else regarding this morning, but it's like, hey, do you want to control rents? Great. Make the ability to create new stock easier, and then rents will inevitably find the equilibrium. And when you don't do that, in our opinion, our estimation, when you do rent control, you're going to disincentivize the owner to make the necessary capital improvements and for capital to flow here, which is obviously not good for anyone associated in that process. Obviously, it's no fun when rent goes up, 10, 20% a year or something like that when we had historical runs. But at the same time, if you create new stock, that should be stymied.
So let's go on to the next market and see what markets look interesting, right? So we've got a snapshot of Dallas, 1.9% versus 3.7%. This is higher construction than we'd like to see, but the employment's pretty good, and Dallas is a very strong market. And today I would say the cap rate, if I were just to put a number on it, cap rate in Dallas would be, call
For what
it,
product?
yeah, I'm just trying to be general, but I would say, B plus and up. I would say it's kind of high fours, low fives, let's say.
Yeah, so you're probably, that means in most instances going in on negative leverage, is that correct?
For
Or
sure.
neutral?
For sure. And we don't have to get into the weeds on this, but I mean, what is positive and negative leverage and what is it based on? Because NOI is not free cash flow because of below the line expenses, asset management fees, professional fees, accounting fees, legal fees, CapEx that people put below the line. So in reality, if you're buying a five cap after layering on construction costs, below the line expenses that are recurring, it's really a four cap. So that's why when you see someone buying a five cap deal, financing it at around five, the cash flow is not 5%. The cash flow is four at best.
Fair enough.
Okay. So let's look at Denver. This just happens to be the next one, but Denver's also one of those hot topics because it was a very strong market, but also ended up being one of the most overbuilt. And you're seeing 1, 2, 3 months free in Denver. I mean, I
Lots of
think
rent control too. Denver's pretty blue now.
on Jay Parsons' podcast, he talked about how there was like this, I don't know, some story that made the news because this guy negotiated on his renewal 2 months free, which I mean, it's fine, right?
That's tough.
If I mean, it's tough for the apartment complex, but if the property's offering concessions on new prospects that walk in the door, it's kind of hard not to offer it to your existing resident as well. And
For
I always
sure.
preach that a renewal is worth more than a new lease, so we should treat our residents better than prospects.
Without a doubt. And just for conceptually for everyone to think about this is going to sound like a no duh, but if anyone is in the restaurant business, whether you have worked in one yourself, whether you have a family member who owns a restaurant, something like that, think about this. If someone is getting 2 months free, that means 1/6 of their rent is discounted, right? Well, what would happen if a restaurant offered 1/6 of the price to be reduced from their margins? Well, that restaurant would probably not be in business, right? That alcohol, profit they can get from selling drinks or whatever, or that food margin is completely evaporated. So that business wouldn't work. Well, similarly, what we are seeing since 2022, ultimately, once supply and rates have gone, kind of been in a challenging point, the growth of rent has really been stymied across the nation. Some places more than others, some places have gone down drastically. But when you hear that, it's very, very challenging for these businesses, for these assets to operate and function and to be prosperous today. But that's also precisely why now is such a great time to also get head into it and to double down on the multifamily strategy.
I agree. So let's take a look at Denver. So
Brother,
Denver,
under the national average?
yeah, and that employment's not looking
Ooh,
so great.
brother,
So yeah, I would not want to pay a very low cap rate in this market
Look at
because
that ratio too. That's terrible. So you've got less than national average on job growth, and then you've got higher national average on construction. No good. No
no
good.
good, no good. So unless you're being offered a deal at a very attractive cap rate that compensates you for these upside down fundamentals, it's kind of an uninvestable market. And that's what we found. You would think that you would see a market like Denver, like Phoenix, where rents crash and you've got this upside down scenario and you'd think, oh, cool, I'm gonna swoop into the market and buy distressed deals at a discount. The problem is they're not there. You can't actually access the assets at the price that you want to justify the fundamentals and the risk. So it kind of just ends up being a stalemate with buyers and sellers, and you just end up at a standstill. No transactions take place. So as much as I would love to say, yeah, people are running from Denver, let's be contrarian and let's go in and we'll buy deals at a great price. They're not there. So
And
it
also on a risk adjusted basis, things being pretty like for like, right? Like let's say your cap rate is like for like in this market juxtaposed to, I don't know, somewhere like San Diego, where do you think will be more viable long term? Where do people want to live more, San Diego or Denver? Well, frankly, it's probably San Diego. So on a risk adjusted basis, that's challenging. And it kind of reminds me of a conversation I was having numerous years ago when I was in the residential business in Phoenix. And what the individual brokers, now a manager at Marcus and Millichap, there locally, doing kind of more that mom and pop size sub 50 unit kind of as the niche there, right? And as he was telling me, he's like, you're better off buying in LA, San Diego, or San Francisco right now because the cap rates in Phoenix right now are like 2.1%, 2.5%. He's like, this is nuts. It makes no sense. Like, this is when the broker is telling you that. You should maybe listen up and hear that. And that was obviously peak insanity of the market. And well, frankly, San Francisco, if you look at it, actually from a rent growth perspective, has been pretty darn good, as has New York City and a couple of other the more gateway markets, you would call it,
let's
which
see if
have a little
San
bit more of a bottleneck of supply.
let's see if San Francisco is on this list. San Francisco, yeah, it is number 26.
With regard to, oh, just you're saying the market, yeah,
Like it is on this
it's
list, which
listed. Okay,
it should be.
let's see if I was right or he was right.
Yeah, yeah. I mean, it's steady Eddie, right? It's a tight market. There's
Yeah.
just you can't build much,
Well,
and
also, you talk about, good fundamentals. Um, I'll do another anecdote here. San Francisco, right? Well, look at the geographical location of San Francisco. It's like what, 47 miles or something like that. It's landlocked or waterlocked
water
on
on
every
all
side of it.
sides. You've
There's
got
tons of
tons of
natural rolling hills and preserves where you can't develop there. So, due to that, you don't have a high supply risk, which is obviously quite accretive for something like this, as opposed to some place like in Texas. Houston has that age-old adage of, oh, well, you could put, a strip club next to a church. While technically true, or, in apartment
in
complexes
some
anywhere.
places. There's more zoning
Some
than you'd
places,
think.
but yeah, there's more nuance there as well. I mean, you can't just build anything anywhere, but for zoning purposes, I mean, you're going to look in 20 years and the Bay Area will look the same as it did 20 years before because nothing is getting done because there's no development, which is a pro and a con.
Yeah, people are scared to invest in blue states, and I think there's definitely some legitimacy to that fear. But there's also tons of benefits of investing in a NIMBY democratic area like San Francisco because it's so hard to push permits through and get anything done construction wise. So San Francisco has the I don't know if it's a trifecta, but you've got geographical supply constraints. You have political supply constraints. And then I don't know, is there a third supply constraint? Either way, it's very tough to get new construction done, as
Well,
evidenced here.
just zoning probably actually, just from a feasibility
I'd
of
call that
construction.
political.
Yeah, because think about this, like to make something possible today, like units and things like that, very challenging because the costs associated to development, zoning, entitling, construction, labor, and that's why you go to those areas that construction quality is, top notch. It has to be because the red tape associated to developing there.
Yeah. And I don't want to shine too much of a light on San Francisco because at the end of the day, we don't have an interest in investing there at the moment. But this employment number, I feel like could those numbers could get pumped up with
Correct. Those are
all
rookie
the,
numbers.
yeah,
Those are
AI
those are
and
yeah, those are rookie numbers. I'm almost skeptical of that. That feels a skosh low to me. But
this
so
could be out of date.
You just mentioned it. San Francisco, we would never invest in there, is what I just heard you say.
Not
Going
never,
back to
but
going back, likely never. Going back to Denver, we didn't get to the crux of that. Would you, Rob, and let's say 15 years from now, would you buy in Denver? Would you? That's the question.
for sure, for sure. Denver is large enough. I think it has long-term tailwinds. People love Denver. So And you're saying, do people pick San Diego or Denver? I mean, San Diego obviously is better, but Denver, it's a close call.
Well, I was just saying for where would you rather own, right? If it
No, I know, but
was
that's what I'm saying.
like for like.
No, totally. I know what you're
Okay.
asking, but I'm just saying it's not like Denver is hot now and it's going to be not hot later. Like I think it
Right.
has long-term enduring demand and great place to live. So I think the numbers are going to work themselves out and you're going to see positive rent growth in the long term there.
You're
So
bullish.
yeah, I'm bullish there for sure. So let's go to Houston. So this is our favorite market.
H-Town, baby.
Yeah, this is I think a sleeper market. I think it's one of the best markets. Really, before we do that, I think according to IPA, they're ranking the markets. They're saying Southeast Florida number one. So that's Fort Lauderdale, Miami, that area makes sense. There's a ton of demand there, but there's been a lot of
There
supply
could be
as
more
well.
demand due to a certain mayor election, allegedly, according to X.
Yeah, I don't know about all that. I think it's a little overblown, but we shall
Of course it
see.
is.
So, so number two is Dallas Fort Worth. No surprise there, right? Like I said, people love DFW. They want to invest there at all mean, by any means necessary. Orlando, right? Florida continues to be a favorite. And then Houston, number four. So Houston's getting its credit here, ranked number four. I like to see that. And then Salt Lake City, fantastic market. Orange County, really great market. Orange County, no supply, good jobs, really good market. Austin, number seven. I'm very surprised to see them rank it as number seven. I think this came out in January of 2025, so this is almost a year old. And the big surprise of 2025 across all these markets, Miami, Dallas, even Houston to a lesser extent, but Austin and Phoenix, the big surprise was that concessions did not burn off. Everyone was thinking that, yeah, supply has been heavy, but the supply is going away, it's getting absorbed, and then that's going to make concessions go away, and then people are going to be back to the races, and values are going to be going up, and rents are going to be going up. We haven't seen that at all. Craig, you toured a deal in Phoenix the other day, and they're offering $1,000 move-in specials.
Well, hey, no, no, no. Allegedly, they're not offering that. Those are burning off according to the broker.
Well, the day you close, magically, the deal will just burn off those concessions.
Correct. Yeah. Why wouldn't they?
So you don't even need to put it into your underwriting. They will just burn off magically the day you close.
No. By the way, what is that ranking? Just so we're all clear, by the way, on that right side, just once more to double click on that.
Well, to be honest, I haven't even read this report, but it says the NMI ranks 34 major markets on a collection of 12-month forward-looking economic indicators and supply and demand variables. Markets are ranked based on their cumulative weighted average scores for various indicators, including projected job growth, vacancy, construction, housing affordability, rents, household growth, and size of renter pool. Weighing the history, forecast, and incremental change over the next year, the index is designed to show supply and demand conditions at the market level. Index ratings do not take insurance costs and natural disaster risks into account.
Fair enough.
Fair enough. So let's get back to Houston. Houston, here we come.
If they're ranking the food market, I mean, that might be top five in the country.
For sure. For sure. Best meal in
See,
Houston.
look, see, look at that incredible ratio. Okay.
Hold on. Best meal in Houston. I'm gonna go with Neo. What about you?
You know what? It would be a very challenging topic for me to fully weigh on this, but I'm very biased to the one and only Taste of Texas. If you are in H-Town, if you're coming to tour some assets, if I'm in town and I'm taking you out, I'm taking you to Taste of Texas.
100%. Okay. So Houston, Craig, I'll let you talk about it because you already pointed out very astutely this wonderful scenario we've
Yeah.
got here.
So employment, 68,000 new jobs coming in. Construction delivery per inventory, 2% below the national average. So you're almost 2x unemployment and just a skosh below the national average on construction. Um, the affordability ratio is pretty incredible here. And we can obviously walk backwards and forwards with regard to this market better than other locations. We're actually acquiring a deal right now that has a very interesting metric that I kind of want to share. And this is also really a large thesis behind the multifamily investment strategy, which is the rent to owning ratio. Okay, so in this market, we've got homes that cost roughly 440K, which in Texas is a lot of money factoring property taxes and insurances. So to own that exact house is $3,300, but to rent in the property that we're looking for, it's 1340 roughly on average. So those tailwinds with regard to multifamily is great. It's also the negativity regarding home ownership right now. But things like that get us very excited. And like the net new jobs coming to Houston's pretty remarkable. You've got basically in every category with regard to country net migration, population growth organically within the area, and job growth. Houston's either one or top three in every single category, which is pretty remarkable. And it's also just a little bit more fundamentally sound of a market to invest in. What do I mean? Well, you're getting a little bit wider of a cap rate than we would get in Dallas. You're still getting the incredible Texas growth story, and it's a lot more reasonable to make the deal positive leverage. And for those who don't know what positive leverage means, that essentially means that your going in cap rate is higher than the interest rate that you size up the deal on. For those who seek those fundamentals, you are certainly not getting that. Call it from 2020 to about probably 2023, and then it became the flavor of the day in 2024, where that fundamental coupled with replacement costs became a very, very important topic. But those are, a couple of the reasons as to why we really like it. And then above and beyond that, our target is to look in areas where there's not going to be a ton of supply coming online. So we're looking for more of that suburban area for our acquisition stuff. But I mean, holistically, the supply here has not been historically terrible as opposed to some of the other neighboring places within the state, such as Austin, which is the worst supply story in the entire country, arguably. You've got Dallas DFW that has a lot of supply you got to unwind, and San Antonio is kind of heinous right now as well. So, of the core four markets you would likely want to invest in, Houston, Dallas, San Antonio, and Austin, Houston is not even close, is the best location. So, and it's kind of funny just to stay on this real quick on Austin. Everyone, I mean, when I'm talking to investors, and I do that all the time, whether it be institutional investors, whether it be family offices, whether it be kind of the boutique, bespoke fund manager who might raise a country club style from their friends, or if it might be, your typical, self-directed IRA person looking to get a little diversification, the $100,000 check writer, right? They ask, hey, are you guys ever going to be in Austin? And the answer is no. And the reason why likely is no. I don't know if it's a short term or long term. And Rob, you'll weigh in on that one. But what Rob is highlighting right now is very clear. So, yes, despite the fact in Austin's a smaller market, so 29,000 jobs is, 2.1%, almost double the national average, like Houston essentially, right? So you still have got basically the same number percentage wise of job growth there. However, the ratio is heinous. Absolutely heinous. Now, two divided by seven, that might be a good baseball batting average, but for the purposes of this conversation, is a terrible, and I mean terrible ratio. I mean, it's quite frankly right now uninvestable. So Rob, I'll let you take it away based on that commentary right there.
Yeah, you nailed it. And so here you see the just to compare Austin versus Houston right now, you've got the same amount of job growth, but you have almost four times the amount of supply in Austin as Houston. So one market is investable and the other market is simply not investable unless and until the construction as a percentage of inventory comes down somewhere more in line with 3%.
But the
The
question right now too, and also there's some pros and cons to this. So ultimately, why this place was ranked, the top markets as we saw before, and we're going to talk about Phoenix later, I'm sure, but Austin, Phoenix, right? Yes, those places are good and they are getting dramatically more affordable. So, one thing that inflation I don't think takes into account as much is, when they do the inflation reports, they call and pull homeowners what they would rent their property for. Not, what, private owner operators and big REITs are renting their places for. And places like Austin have absolutely heinous levels of supply coming online that have really, hurt owners, but have done what? They've made things incredibly affordable for those who work and live in the area. So that's why it's ranked there. But from a regards to an investment perspective, I really don't think it's investable right now, unfortunately. I really think we're years away from being years away, right? As they say, a year away from being a year away. Well, I think we are years away from this working out. And the other kind of interesting thing about the Austin market is because it's got so much glitz, it's got a lot of sizzle, right? You've got Meta there, you've got Tesla moving there, and even kind of headquartered there. You've got all these incredible, high-paying white-collar jobs and such. A lot of growth there going in, so it has that sex appeal to it. It's got that aura, it's got that panache. But unfortunately, it just doesn't really necessarily pencil with regard to making an investment when you've got concessions that are going to be burned off, when you got a cap rate that's frankly a lower cap rate than what a deal in Dallas will do, right? So it's just, although some things sound nice, like, hey, I would like to own in New York City. Well, guess what? It really doesn't make sense financially in many respects, relative to opportunity cost.
So that's the really interesting thing because if I told you, sure, there's oversupply in Austin and you're not going to see rent growth and you're going to be battling concessions, but you can buy this great deal for an 8 cap. You would say, sure, sign me up. That sounds great. I will eat the concessions for however long it takes to normalize because I'm in at an 8 cap and I'm going to be fine. The problem is nobody's selling 8 caps in Austin, right? They're selling 4 caps. So I don't this yield level indicator over here in the top right. I don't think it means necessarily. I don't think it correlates to cap rate, but it kind of works nicely. They rate the yield a 4, and the higher is better. So Austin, you get a 4% yield, but you have to deal with all this mess. Same thing goes with Dallas to a lesser extent though. So Dallas, they give a score of yield of 4. Same thing. Cap rates are low in Dallas, 4. I mean, I don't want to say too many, I don't want to say anything negative about Dallas because I really, fingers crossed, we buy a deal in Dallas soon. But yield of 4 in Dallas, but you're dealing with almost 2x the construction as in Houston. So, okay, fine. But then what's the yield in Houston? Certainly the yield should be equally low in Houston because the supply and demand fundamentals are better, right? But when you go to Houston, it's actually not true. They rate the yield a 7, and the supply demand is infinitely better. So this is why I think Houston is so underrated because you can buy in at a better cap rate and your fundamentals are superior. So, your only downside, I'm oversimplifying here, obviously, because everything is nuanced and you don't invest in a market, you invest in a deal in a neighborhood, in a submarket, in a market. So at the end of the day, it's much more micro, and we do get micro, and I want to actually touch on that if you'll allow me in just 1 second here. So this 7 yield is incredible. The only downside, I'm getting good yield, I'm getting better fundamentals. So I'm getting better fundamentals, better yield. What am I giving up in exchange? Well, like you said, I don't get the sexiness and the name brand of Dallas and Austin, right? There's more clout and panache associated with investing in those markets than
More
Houston.
je ne sais quoi.
More je ne sais quoi. I get it. But and then the other thing is natural disasters. The other thing is the
Well, yeah,
weather risk is more pronounced in Houston. So
yeah.
let's not totally ignore that.
It
But
ain't like there isn't hail though in Dallas, or
exactly, yeah.
a freeze is in Austin, right? No, 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 no. Texas market from a weather perspective is bulletproof. To be clear,
Nothing's bulletproof, right? There's a give and take. The market is efficient. People are smart. I do feel like this is a little bit of a mispricing though. I want to go back and touch on supply
but
because
oh, I have something else to mention
yeah,
too.
yeah. So let me touch on supply because you nailed it earlier talking about San Francisco, and I just want to talk about our investment strategy because supply is important to our investment strategy, of course, and it should be to anyone's because unless you're a flipper, and when I say flipper, I don't mean like a single family home flipper. I mean
A hot
buying.
potato
Yeah,
investor.
you buy apartments and you try to do value add real quick and sell in 2 3 years and get a nice IRR pop. Unless you're a flipper, because then supply doesn't really matter to you because you're in and out so fast. The market doesn't change on you typically fast enough to really matter. So if you're a longer term holder like us who's really trying to invest in the market, then you really need to be very cognizant of supply. And so what we do is even though that we invest in markets like Houston, which are generally speaking much easier to build in than places like San Francisco, we are still looking for those pockets where it is challenging to develop, either because there are geographical constraints, which admittedly there are few and far between in Texas because you've got land as far as the eye can see. So rarely do you have, bodies of water or mountains or other geographical constraints, although they do exist by the coast. And the other piece is there are parts, believe it or not, of Texas and in Houston that are politically constrained with development because you can have local, you know, governments that are not as friendly to development. So we are looking for the political constraint, the geographic constraint, and also, very importantly, because this really does apply to our strategy, we're looking for that economic constraint. And what that means is basically we're buying in suburban areas where the rents are essentially naturally occurring affordable. So call it rents that are between 1,300 bucks and
17.
1,700 bucks.
No.
Because the reason for that is that's a great sweet spot for Class B assets, but also it's not high enough of rents for a developer to be enticed to build. Because if a developer is going to spend all the money to buy the land, to do the construction, to do the construction financing, they need rents that are 2,200 bucks and more in order to justify their exit, to justify all their costs. So we are essentially economically insulated against competition, construction competition, because the rents in that general area are lower. So you might be giving up a little bit of growth because you're not in the glitziest area, you're not in the area with the most growth, you're not in the area with the highest paying jobs and the highest household incomes, but you do have that somewhat of a economical supply moat.
Without a doubt. Something that's interesting too, and I think the reason why Houston does get, the rap is number one, coastal, right? Obviously, there's hurricane risk associated to Houston. But before that, Houston used to be known a little bit more as a oil and gas boomer bust city. However, the economy is now substantially more robust than it had ever been before, and the Houston city has really invested heavily into medical field, medical industry there, technology companies, and also the oil and gas is really coming through as petrochemicals, which basically everything, if you're a gal, you'll appreciate this. Every piece of makeup that you have needs the refinery, needs the petrochemicals coming through it. Most plastic goes through that, right? So it's a very, very inelastic manufacturing part of the economy that Houston has to offer above and beyond everything else that it's seeking and attracting and getting. So for those purposes, it's not your old Houston. And just like Phoenix, obviously Phoenix is going through a battle right now. Well, Phoenix used to be kind of that boutique market that didn't really have that many jobs there and whatnot. However, tech has really improved the economy here locally, and it's a lot more robust than it's ever been before. So a lot of these locations are starting to absorb a lot of the tech industry and other kind of ancillary job diversification places to make it not as cyclical and boomer bust long term. Unfortunately, the moat on tech, although it's still the highest and most concentrated in the Bay Area, well, a lot of those companies are starting to piece by piece have satellite offices in different regional locations throughout the country, whether it be in Austin, whether it be in Nashville, whether it be in New York, obviously. But Houston is also one of those places, and a player, Denver similarly.
I just want to highlight some really cool markets like Orange
So wait,
County.
real quick, so we can wrap up in Houston and go to the next thing because we kind of were waxing poetically there. Houston, it's frankly to this point our bread and butter market. Any other kind of final points there before we let people go on that subject?
No, no, I think
Cool.
we covered it.
Yeah.
So we'll go a little bit faster here on markets. So Orange County, amazing market in California. You've got geographical constraints and so on and so forth, and that's evidenced. And you have political constraints as well, hard to build. Look at this. This is incredible. There's just no construction going on here. This is amazing. This is
That's the
probably,
best. That's the best race we've seen.
yeah. I mean, you've got more jobs than the national average, more job growth, and then just absolutely no supply. I mean, I love this. This is amazing. Really fantastic. Very
And I'm
stable.
sure if you saw the 2018 version of this, a lot of other markets that were key were probably looking like that. No, maybe not
Probably
there,
not
but
not quite like this. I mean, this
no.
is really low construction. This is problematic. Like the city needs to be, these cities in Orange County need to be figuring out how to get more construction done. It's very problematic. And so you're so stable, you're in such a desirable area. The yield reflects it, right? It's a 3. That's the lowest yield we've seen so far. So you are paying a very low cap rate. The cost of entry here is very high to be able to get access to this strong of fundamentals. So just a point there. So let's look at Phoenix, a punching bag for many, but a high flyer nonetheless.
And a home
So
to me.
yes, home to you. So you can see the employment is a decent tick
Ugh,
over.
ugh, ugh. Ugh, that ratio. Ugh.
Yeah, no, not a pretty ratio. Very bad. Very, very bad. This is nasty.
Ugh.
So it's going to take quite a while for this construction to really work through the system here.
Let me paint a picture too. So when I drive around my neighborhood, I'm in the 85018 zip code, kind of that most eastern part of Phoenix, essentially, just for those who are not privy, that essentially borders to Scottsdale. So kind of below that Camelback Mountain area. And when I drive on Indian School, a very popular grid location, I notice all the time, and I'm really honing in on this, all the concessions. And when a company, or sorry, an apartment complex is saying, 2 month free rent, well, it's probably more than 2 months, and it's probably a little bit more, maybe like a bag of chips thrown in there as well. So that said, when you see that, that's a massive pressure problem. So although the IPA ranked, Phoenix as a top market, it quite frankly, in most instances, is quite uninvestable. But with that said, Rob, Phoenix, is that a place we want to invest in?
Yes.
Are we actively looking?
Yes.
Yes, I actually toured a property the last 2 weeks, actually. Separate properties, different locations. One property was just really not a fit due to a multitude of reasons. Another one I actually toured the other day was large acreage. They would never build stock like that again. And kind of funny, and I'll leave the final comment here. 80s, 90s, 70s, and 2000s all means different things in different locations. 80s in Phoenix looks like 90s in Texas, interestingly enough, meaning that the quality is a little bit higher end in Phoenix for that.
Yeah. Also, the weather is more forgiving on the real estate in Phoenix.
It's just oppressively hot. It's not
It's just
really,
hot, but that doesn't
yeah.
really, that's not so
The lack of humidity is probably good for, construction as well, and in homes and stock and product and multi.
for sure. For sure. So yeah, Phoenix is a market right now, as you can see just by these numbers plainly, it's uninvestable. The yield is rated a 5. I mean, we know the yields, right? They're in the 5% cap rate range, but you can't do that because your real
You don't even know what the real cap is when you've got concessions galore and all these specials going on, right? Until that is kind of digested, we don't know the price.
exactly. Exactly. Okay. So makes Phoenix very tough. We'll consider it. We'll give it a score of uninvestable, a 0.
And just so we're clear here, everyone, too soon is still wrong. Too early is still too wrong.
Correct. Correct. Okay. So let's keep it rolling. So we're gonna skip over Portland.
Joe Millo just asked, please explain why Phoenix is uninvestable, yet you want to invest there. Well, I think we just stated that although, yes, it's uninvestable today, long term, we do really, really like it. And to that point, Joe, why we like it is, and why also, I don't know if you answered the Florida question, but we really like it because it's very complementary from an expense ratio perspective and also an ownership. So there's no weather risk. Insurance and property taxes are substantially cheaper in Arizona as they are in Texas for a multitude of reasons. So that's a nice benefit and complementary to the portfolio and to our investors from a geographical perspective. And ultimately, we're looking to be in some of the top and largest MSAs that we're going through right now. So for those reasons, we love Phoenix. It's a right now thing that we don't like.
Yeah. Yeah, we're dying to get in. It's just a matter of when.
Yeah,
So
but we can't want to die so much that we're going to do it because we can raise money for it at the expense of, not having the performance being exactly what we want it to be. And then did you mention, maybe just kind of a perfect kind of segue into the Florida? Are we interested in investing in Florida, Rob?
no, I answered this in the chat, but basically nothing against the Florida markets. There's some really great Florida markets and dynamics there, but it's more of the same to Texas. So when we're looking to expand outside of Texas, we're looking for complementary markets. We're looking for markets that afford us something different. Like, for example, Texas, it's a red state, high property tax state, no income tax state. It's all the same as Florida. So it's just very similar. We would rather perhaps invest in a market where there's low property taxes, like Phoenix, right? So
Hmm.
you're getting some complementary dynamics, a little bit different, and yeah, I think we're looking for some more complementary markets rather than more of the same sort of exposure.
Yeah, whether it be weather, insurance, property
That's another
taxes.
reason. Yes,
Yeah.
Florida, similar insurance problems like Texas.
It's actually worse. Florida is substantially worse. The entire state is the highest tier hurricane risk. So even if you're an Orlando investor, right? Think about this. Even if you're investing in Orlando, your insurance is pooled together with those who are in the more coastal areas like St. Petersburg, Tampa, the Keys, Palm Beach, Miami, you name
Yeah,
it,
it's
Fort
tough, very
Lauderdale.
tough.
It's brutal.
So let's go real quick. Raleigh. So the Carolinas are really fantastic markets. There's a ton of growth there, a ton of interest from capital as well. But if you just look right now, it's a tough picture. Raleigh, 2.6% employment. It's really great.
Oh,
Research triangle, but the construction is 7.2%.
ugh,
It's uninvestable. This is just horrible. And the yield
ugh.
is rated a 4. You can't do it. You just can't.
Would we
So
ever would we ever own in the Carolinas?
I can't say no. Again, it's somewhat similar to our Texas exposure, but I can't say no. It's great markets, but just it's not really that great right now.
Sure.
Uh, okay, this deal right here, Riverside. So Riverside has some supply, a little bit better employment, so nothing really to write home there. Um, Salt Lake, same thing, a little bit higher construction, but pretty resilient market.
When we were talking the other day, actually, and this is the genesis of actually the theme of this podcast was I asked, "Hey, Salt Lake City, I love it. Really, really a lot of growth there. Lots to like about the city itself. This ratio is not heinous. Obviously a little bit better on the employment, a little bit of a better ratio on construction. Still not great, but that'll be absorbed and do fine. My question for you is would we invest in Salt Lake City?
Okay, so I have only looked at a few deals ever in my career in Salt Lake. I don't know much about the market, but just look at the yield score, 2% or 2. So basically, if I were just to do some random math in my head, I would say, well, that means the cap rates are like 3% in Salt Lake. And that makes sense because it's a small market and there's very limited deals. There's not like a million deals that you can go and buy. So there's going to be a bunch of big players competing on every deal that hits the market. So they're going to be willing to go all out and pay crazy numbers for these deals. So even though the fundamentals don't fully support it, the cap rate's super, super low. Here it says Salt Lake City is one of 16 other major markets to record net absorption for each year since 2019. So it's been kind of the most steady, the most resilient, most consistent growing market, and it's noting the fifth fastest pace of job growth in this time from 2019 to now. So it says these favorable factors contribute to a low yield rating of 2. So it's like there's really not much of an opportunity. Low yield of 2. We can't do it. Good
Hmm.
market can't do it. It's too small.
By the way, one of our beloved capital partners, investors, just emailed us saying Houston MF looking good on absorption. We agree. We're seeing the same thing.
Lowest supply in Houston right now in the last 15 years. So very strong.
People aren't talking about that enough.
No, they're not. Okay, San Antonio. Oh, not my favorite thing to talk about. San Antonio has crazy population growth, great job growth, so many good tailwinds. It's doing great. Problem is, it's getting crushed with supply, and also something that we're kind of experiencing anecdotally. It's getting hurt with the deportations and the ICE stuff and all that sort of kind of micro effects to this market that are unique.
Not a
So
terrible ratio though.
but it's not a terrible ratio. It's not as bad as its neighbor, or Austin. So they are very much connected,
True.
but it's not definitely not as bad. And that's because San Antonio is the more affordable option than Austin. So the developers who overbuilt everywhere, they focus on Austin instead of San Antonio because in Austin you've got the high rises, you got the higher rents and more growth. So you can see the yield is rated a 6. So that's actually very good, although it's still not as good as the 7 yield that they rate Houston, and the supply demand is better in Houston. But San Antonio, I feel like we've kind of bottomed out in terms of fundamentals, and I think we're going to start going forward. So we are actively searching for opportunities in San Antonio because I think sentiment has been negative for so long there now that it's time. All right, we're almost wrapped up here. San Diego, it's an interesting one to take a look at. Not very much meaningful job growth whatsoever, but also very little construction. So I would say this is pretty interesting, but the yield is 2. So good luck.
Yeah.
Pretty insane. All right. I think we are pretty much wrapped up.
We did
Here's
Nashville as a final one. Was that even listed there? I would love to go and dive into that.
Yeah, I mean, so Southeast Florida, real quick before we go to Nashville, it's pretty solid. It's like Houston, right? So this area, which includes Miami and West Palm Beach, you know, the yield is pretty decent. The supply demand's pretty decent. I understand why people really like this area, and so I don't think it's a bad play whatsoever.
No.
And then we are going to go to Nashville.
Would we buy in Nashville?
I
I
mean,
I clump it with the Carolinas.
yeah, I
Like
don't I don't think it's a great.
conceptually, yes, but right now Nashville's heinous. Yep, there we go. Oof,
Yeah, it's
that's
like you
not
have
good.
below average employment growth, yet twice as much construction. So it's like this whole narrative that, oh yeah, if I invest in the Sunbelt market in the South, I'm going to get great job growth and therefore great rent growth. But actually, you've got worse employment than the national average, and then still you're battling supply.
Tough.
Tough stuff.
Well,
All right, well,
any
that
wait, we got 5 minutes left. If there's anyone here so far that has not asked a question that has been thinking about one or wants to ask a question now, we would love to take the final 4 minutes to answer that. And then I guess conceptually too, is there anything else you want to share, Rob, about where we're at as a company, how things are going? Let's just maximize this hour here to the fullest potential.
okay. So. Well, we have a question from Israel in the chat and the Q&A. As a long-term investor, how would you assess the future attractiveness of a market you're interested in terms of the job growth and positive dynamics? So the thing is about markets is they don't pivot on a dime, generally speaking. So you can kind of bank on these trends to be long lasting. So if you see a market that's booming with jobs, it's probably going to stay booming for quite a while. Now you want to kind of keep up to date with it, but you can kind of bet on it for a longer term. Yeah, it's a funny one. So yeah, that's from a job growth perspective. Supply also, it's actually the easiest thing to uh, kind of forecast in the near term because it takes so long to, get permits, then put a shovel in the ground and then develop and all that. So you can't forecast necessarily supply over 10 years, but 3 to 3 years ish, very possible. And so then again, at the end of the day, you want to rely on those supply moats that we discussed earlier, geographic, political, or economic. And so that's what we look at. That way it protects us in a, 5 year, 10-year hold scenario.
Rob, let's answer the hard-hitting question. Everyone's been talking about it. Everyone wants to know, are you or are you not allergic to Rolexes? True or false?
False. I am a proud owner of a 2025 Pepsi. And also I'm a very big fan. I don't think I'll ever own it, but I'm a very big fan of vintage Daytona.
Like a Paul Newman?
Of course. Of course.
Yeah, yeah, yeah. I'm a sucker for a day date. Yeah. Well, I guess you've answered. You've answered the hard-hitting question there. Ooh, a lot more questions coming in. I love it.
I do kind of regret selling my platinum Daytona. I will have to admit it. It pains me to admit it. All right. How are you mirroring or planning to mirror your property management team and processes from state to state? And how did you find your in-house property managers? Great question. So basically, when expanding to a new market or even expanding to a new property in an existing market, we have to bring our people there. We have to hire new people there, and then we have to train them and kind of inculcate them into the LSCRE way. And so the best way to do that is just by having our team on site. So, for example, I was on site the day we took over Discovery at West Road, our newest property in Houston, and our director of construction was on site with the existing maintenance team. And I filmed some videos of him. He's taking them around saying, "Hey, this is how we do things now, and this is the standard of quality that we demand." And it wasn't like he wasn't yelling at them, but it was inspirational. And they were like, yes, yes, this is cool. We're excited. So you got to do that on the construction side. You also have to do that in the office, and you have to show them kind of the standard of quality that we're looking to deliver. So when it comes to going further out, it just makes it a little bit harder. Maybe instead of a drive, you have to go on a plane. But there's no secret. You just have to be there in one way or another. You have to get your people to the property. And so The number one thing, the most important thing are the people that are on the site day in, day out. And
Yeah,
so
it's kind of funny because we think about this, you're buying a $50 million business, right? However, it's managed by people who are making like $100,000, right? Which is good money, but these are important decisions. And, the on-site team is the straw that stirs the drink, and different people get different results, whether it be operators, managers alike. So shoring that up and is the most important thing. And you can't just throw money at something and think it's going to go away. Like you've got to get the right team, the right people from a culture perspective to truly have that buy-in.
yeah, so you have to hire the right people. And at this point, we've built an amazing process and team and culture that attracts amazing people and vets them out and gets them excited to join the team. So we got to hire the best people, and then we have to supply them the support, which is the corporate support as well as the training to make them their best that they could possibly be. All right, well, let's wrap it up here. I've got to tend to an important phone call and some other matters. All
I
right. Well,
see.
thanks everyone for being a part of the LSCRE podcast live edition. We'll be back next month. So just stay tuned for another registration link to be live with us on Zoom. And also, this is being recorded and will be posted as a regular podcast that we publish. We're
Monday.
anywhere that you get your podcasts, whether it's YouTube, Spotify, or Apple. We post podcasts every Monday and Friday, and also I'm doing a bit of a solo pod slash video on Wednesdays. So more to come. Please subscribe on our YouTube channel. Follow me on
Hey, shoot me
Instagram.
an email if you have any questions. craig@lscre.com. If you're looking to invest, if you're looking to learn about partnering with us, if you've got any inquiries, topics, you name it, I want to hear it.
All right.